You've worked hard, saved up $100,000, and now you're ready to invest. But here's the problem. Putting that money into the wrong ETF could mean leaving over $3 million on the table over the long run. That's why today we're comparing two of the most popular dividend ETFs, SCHD and QYLD. Both pay you cash, both have loyal fans, but they couldn't be more different. In this video, I'm putting SCHD and QYLD head-to-head. I'll show you and Josh how they work, what's inside their portfolios, and how they've performed over the years. We'll look at dividend safety, the risks each one carries, and in the end, run a $100,000 side-by-side projection to see which ETF truly comes out on top. Over the long run, both are projected to pay over $20,000 per month in dividends, but only one of them has the potential to add an extra $3 million to Josh's portfolio. Stick around. When it comes to dividend ETFs, two names almost always spark debate: SCHD and QYLD. They're both massively popular, but for very different reasons. Let's start with SCHD. Officially called the Schwab U.S. Dividend Equity ETF, it launched back in 2011 and is managed by Charles Schwab. Its job is simple: track the Dow Jones U.S. Dividend 100 Index. That index focuses on large U.S. companies with a history of paying dividends and, just as important, the financial strength to keep paying them in the future. SCHD spreads its money across sectors like healthcare, consumer staples, energy, financials, and technology. It's also one of the lowest cost ETFs out there, with an expense ratio of just 0.06%, which means more of the returns stay in your pocket. At its core, SCHD is designed for long-term investors who want steady dividend income and a good chance of seeing those payouts grow over time. Now, QYLD takes a very different route. It started in 2013, and it doesn't go looking for dividend-paying stocks. Instead, it owns the NASDAQ 100, the tech-heavy index packed with names like Apple and Nvidia, and then sells covered call options on it. I know options can sound intimidating, but the idea is simple. QYLD gives up some of its future growth potential in exchange for guaranteed income today. That's why the dividend yield is so huge, often hitting double digits. More on that later. But of course, there's a trade-off. The growth side of your investment doesn't really get to shine. And with higher fees of around 0.6% than SCHD's 0.06%, a smaller base of investors and less price appreciation, it's definitely playing a different game. So SCHD is all about owning a diversified basket of reliable dividend stocks and letting them grow. QYLD is about squeezing income from a concentrated group of tech companies by selling options. One focuses on stability and long-term growth, while the other maximizes income right now. Now let's talk about how these funds actually trade in the market, because performance is only part of the story. Liquidity and trading behavior can make a big difference, especially if you ever need to buy or sell quickly. Starting with SCHD, it trades around $27 a share. Over the past year, it's bounced between a low of about $23.87 and a high of $29.72. Right now, it sits about 8% below its peak and roughly 14% above its low. That range shows SCHD has been relatively steady, moving with the market but not swinging wildly. It also trades heavily, with more than 16 million shares changing hands on an average day. In dollar terms, that's over $400 million moving daily. With that kind of volume, investors, big or small, can enter or exit positions without much impact on the price. Now compare that to QYLD, which trades closer to $17 a share. Its 52-week range has been between $14.48 and $18.89. That's about a 10% drop from its high and nearly 18% above its low. And while it does trade millions of shares a day, the dollar volume is much smaller, about $80 million daily versus SCHD's $400 million. That's still plenty for retail investors, but it shows QYLD isn't as institutionally dominant as SCHD. But numbers on a screen only tell part of the story. To really see what these ETFs are made of, you've got to see what they actually own, because behind every ticker symbol is a basket of companies that can either keep your portfolio steady or drag it through some rough waters. Take SCHD, for example. One of its biggest strengths is balance. It spreads its money across different corners of the U.S. economy: energy, healthcare, consumer staples, industrials, tech. This means no single sector dominates the fund, which gives it resilience when markets shift. For example, if tech stocks are struggling, healthcare or consumer staples might help balance things out. Looking at the top holdings, you'll see names like AbbVie, Chevron, Coca-Cola, Home Depot, and Lockheed Martin. These are established cash-generating businesses with histories of paying and growing dividends. In total, the top 10 holdings make up about 40% of the fund, but the rest is spread across dozens of other solid businesses, giving it plenty of cushion. Now, QYLD takes a totally different approach. Since it tracks the NASDAQ 100, its portfolio leans hard into tech and communication services. Over half of its portfolio is in tech, with another big slice in consumer cyclical and communication stocks. Its top holdings include the giants: Apple, Microsoft, Nvidia, Amazon, Tesla, and Alphabet. The top 10 companies alone make up more than half of the fund. That means QYLD is far more concentrated. In a couple of minutes, I'll show you how these different holding styles play out in the long run, and I'll show you how both ETFs can still pay over $20K in the future, but only one of them can add an extra $3 million to your portfolio. But first, how have they performed until now? Over the past year, both funds have taken a couple of punches from the market. SCHD slipped about 3%, while QYLD dropped closer to 5%. Not a huge gap, but notice the pattern. When things get shaky, SCHD tends to hold up just a little bit better, while QYLD feels the swings a bit more. Zoom out to the last 3 years, and the separation becomes more noticeable. SCHD has grown about 20%, while QYLD has inched forward by only 6%. This is where you start to see the trade-off. SCHD compounds slowly but steadily, while QYLD's covered call strategy puts a cap on growth, trading long-term gains for those steady income checks. Over the 5 years, the gap is even more significant. SCHD is up 48%. QYLD, meanwhile, is down over 20%. That means a 100K investment in SCHD could be worth around 148K, while the same in QYLD would have shrunk to under 80K. That's a tough pill to swallow if you care about preserving wealth. And if we take the 10-year view, the picture is undeniable. SCHD has more than doubled, climbing 115%. QYLD, down roughly 26%. Yes, QYLD has paid out a lot of income, but the underlying value keeps eroding. So what does this really mean? SCHD builds long-term wealth and a stream of growing income. QYLD gives you those big payouts right now, but at the cost of slowly draining your capital. Which one feels better depends on whether you value security tomorrow or income today. Dividends are the heart of this comparison, so let's take a closer look at how reliable they really are, because a big yield doesn't mean much if it can't be sustained. Starting with SCHD, the dividend track record is rock solid. It currently yields about 3.82%, which is comfortably higher than the market average, but still very sustainable. More importantly, SCHD has a history of consistent growth, with a 10-year dividend growth rate of over 10.43%. That means investors aren't just collecting income today, the income itself keeps rising year after year. SCHD has also managed to increase its dividend for 13 straight years, which is a strong sign of reliability. From a risk perspective, SCHD isn't bulletproof, but is considered relatively stable with moderate volatility. For long-term investors, that combination of growth and safety makes it very appealing. Now compare that with QYLD. This ETF is famous for its massive 13.06% yield, which immediately grabs attention, but that yield hasn't grown much at all. Over the last decade, its dividend growth rate has been basically flat at 0.16%, and in some periods, dividends have even declined. QYLD technically has a 10-year history of paying dividends, but only 1 year of consecutive growth, so stability is questionable. Add in the fact that it's highly concentrated in tech and relies on market volatility to fund its distributions, and you can see why the risk is higher. You can see that clearly if you look at QYLD's yield history, it jumps all over the place. In some years it spiked above 16%, other times it slid down nearly 11%. Right now it's sitting around 13%, which looks amazing on paper, but here's the thing, those highs usually come during periods of extreme market volatility, and they don't always last. If you zoom out over the long run, a more realistic expectation for QYLD's yield is closer to 8%. That's the level where it can continue paying investors without depending on unusually wild markets. Part of the reason the yield looks so high today is because the share price has been sliding over time. When the price falls, the yield percentage goes up, even if the actual dollar amount of the dividend stays the same. So yes, the big double-digit yield grabs attention, but if you're building a strategy around it, 8% is a much safer number to plan with. On paper, it sounds simple, steady growth versus sky-high income, but numbers only tell part of the story until you actually put dollars behind them. So let's do that. If you or Josh invested $100,000 into SCHD or QYLD, what would your portfolio really look like? Not just today, but 10, 20, even 30 years from now. Let's start with QYLD. For this, we would be using an adjusted dividend yield of 8%. Its dividend growth is basically flat at 0.16%, and the share price has actually been sliding at around negative 2.78% a year. Based on these metrics, in year one, you'd collect about $8,000 in annual dividends, and your account would grow to roughly $105,000. By year 10, your annual income would climb to about $18,000, and the portfolio would be valued at $185K. At year 20, the payouts balloon, $57,000 a year, with your portfolio sitting at around $457,000. By year 30, the portfolio is projected to be valued at around $1.62 million, paying about $260,000 in yearly dividends, which comes out to roughly $21,500 per month. Now the question is, can SCHD beat these returns? SCHD has a 3.82% yield, with strong dividend growth of 10.43%, along with solid annual price appreciation of 8.51%. Based on these metrics, by the end of year one, you'll earn about $4,000 in annual dividends, and your balance will grow to roughly $112,000. After 10 years, your income will rise to about $13,000, with your portfolio climbing to $330,000. By year 20, income will reach around $57,000, with your balance topping $1.1 million. And by year 30, the compounding kicks in. Around the 30-year mark, the portfolio is projected to be valued at around $4.59 million, paying an annual dividend of roughly $265K, or about $22,000 a month. If you look at the dividend income, you'll notice that by year 30, both QYLD and SCHD are paying out almost the same amount. QYLD is projected to hand you around $260K a year, while SCHD comes in slightly higher at about $265K. On the surface, that looks like a tie. But with SCHD, your portfolio isn't just paying income, it's also growing in value. After 30 years, SCHD's balance is projected to reach $4.59 million compared to QYLD's $1.62 million. That's almost an extra $3 million sitting in your account on top of the income. So which ETF is right for you? It really comes down to what you value most. If your priority is income today, and you like the idea of steady monthly cash flow, even if it means your portfolio might shrink, then QYLD may fit your style. But if you're focused on long-term growth, and you want your income to grow alongside your wealth, SCHD is the clear winner. QYLD is an income-focused ETF, but as we saw, it struggles with NAV erosion. Want to know the top 7 income ETFs that pay strong dividends without losing value? Click the video on screen.